I'm Keith, and welcome back. I thought that was an excellent discussion with Nadine, a good back and forth on how a modern day portfolio manager is risk managing these markets in the cycle. Now I want to get into I was going to call it a rabbit hole. It's actually a massive rabbit hole on a rabbit hole set of topics, I guess, or series of rabbit holes here, Chris, that only Chris Whalen can really dig into, each and every one of them, within the banking system. I know you'll have a lot of questions on that, so please fire your questions into the queue. They'll be voted on, and then I'll ask them. But Chris, thanks for making the time as always. I appreciate it.
My pleasure, Keith. I hope you're all well.
Yeah. So today, you got people that are freaking out for whatever reason they are today, but they're like, oh my God, J.P. Morgan said this, Wells Fargo said that, and the bank stocks didn't go down today. Can you get into? We went over it in our morning meeting. Relatively low versus what we thought they should have taken. J.P. Morgan loan loss provisions, for example. That topic in particular, you have an explicit view on. So maybe go through that view and frame it within the lens of what J.P. Morgan had to say.
Well, when I looked at the industry, Keith, in my earnings note over the weekend, I was trying to figure out what do we do with this crisis, because it's different from 2008. But it's also very clear that unemployment, which is the first factor in any credit model, is going to be very important. And also small and medium-sized enterprises are going to be going through the meat grinder. So when you put all that together, you end up with not just high levels of default for both banks and bond investors to deal with, but you also deal with the economic consequence, which to me says we're going to go into an L-shaped recovery. We're going to kill a lot of the service sector. It's not very well capitalized. They don't have the money to be out of business for 2 months and keep everybody on the payroll. So when we emerge from this, I think we're going to see a U.S. economy where a lot of the services sector that we've depended on in the past for employment and growth just isn't going to be there. The banks themselves are fine. They're overcapitalized. They've stopped share repurchases, which is what you would expect, and that's enough. We don't even have to talk about dividends, Keith. It's $110 billion in new capital funds are going to be retained by the banks because they're not doing share buyback. And that's enough to fund your reserve bill, by the way.
Well, I think, and that's kind of like you summarily just knocked down all the pins like as only you could. But taking each pin out, like let's go through them. Because you said that loan loss provisions can double then double. And some people think, okay, look, what just happened at J.P. Morgan or Wells Fargo is as bad as it gets. Like, why is that not the case?
Well, the banks and really all lenders don't know what's coming yet. They have a lot of ideas in anecdotal terms, and there are a lot of credits that have certainly slipped from okay into special mention at the end of this quarter, which is how the regulators view these things. But we still don't know what the totality of defaults this quarter are going to be and how that's going to play out for the rest of the year. Okay. So my guess is the banks like JP and Wells are going to take some hickeys now. They're going to put some money aside for loan losses, but then they're going to have to go through the entire second quarter and deal with all of that. Not just the credit component, but the operating component, the expenses, all the stuff related to doing high-touch servicing for distressed borrowers, consumers, businesses, it doesn't matter. It's 10 times more expensive when somebody has a problem. So when you put all that together, my sense is the industry is going to be hurting on the expense side in the second quarter, and they're also going to have to take more credit loss provisions, because if we're at 25 or 30% unemployment short-term in this country, then we're talking about the 1930s in terms of dislocation.
Yeah.
And the banks will still be fine, but will consume most of their income this year.
Well, that's the big difference too when you talk about the cyclical loan loss provisions that companies report quarterly, and then the systemic issue which you've just highlighted. So can you go through that, the difference between that on the employment side and 08 in particular?
Look, in 08 we had dislocation. We certainly had a lot of job losses. You saw it in the unemployment numbers. But by and large, the rest of the economy, the services economy, everything else, it had to slow down and downsize, but we didn't just cut large chunks of it out so that they're not there anymore. And I think in the hospitality sector and the travel sector, anything related to those types of services, we're going to find out that even when we get people back to work, these services just aren't going to be there. So I think for banks, the expectation of loss is quite high. But again, remember, we're not talking about a systemic liquidity crisis where we had trillions of dollars worth of mortgage securities, subprime mortgage securities that nobody wanted. We've had some of that in the bond market, but to their credit, the Fed has come in and really done a great job of stabilizing the market for the moment. But I think going down the road, we have to anticipate that both financial institutions and bond investors across all these sectors that are not supported directly by the government, like auto loans, credit cards, all of those sectors are going to see big, big defaults.
Yeah, when you look at that, I mean, we've done all the work historically. Of course, at least we've tried to be macro aware at a base level on that, in terms of what this actually means. And I have a hard time not characterizing the labor market and the consumption drawdown as anything other than a depression. Now, you can't call, I don't have to call it the Great Depression because that's the greatest depression ever, but the numbers that we're going to have here are pretty damn close to where they were back then. Guys, if you want to throw up slide I think 34 in the current macro deck. How do you think about that? Because a lot of people that I talk to, I mean, we talk to the same types of people, I suppose. Some people want to believe that. Some people can't afford to believe that. There are a lot of different paths I go down on this one, Chris, because as Yogi Berra would say, you get to a fork in the road and you take the fork. What is it about a depression on the employment side that we have no case study other than the depression that should be concerning here?
Well, the concern, of course, is that when you allow deflation to run through an economy, you destroy a lot of jobs and you destroy the enterprises that create jobs, which are small businesses. They don't come back immediately. It takes time for that to occur. Mm-hmm. And so I think what you're left with is a large body of the population who may not be able to find employment, and they may need long-term support. This is a big, big issue, I think, because again, I think we're going to see an L-shaped recovery. In other words, we're going to get people back to work, and yet we're going to find that GDP has dropped down 10, 15% in terms of the run rate. Now, I think the same thing will then be reflected in earnings. Think about the drop in credit card transactions over the last month because nobody's going out. They're spending money, retail sales are up. But I think when you really look at some of the internals for the banks and payments in other areas, you're going to find out that it dropped off rather significantly. Mortgages. I was talking about banks getting back into the sector in the beginning of the first quarter. Now, no, they're totally withdrawing. In fact, you'll find this amusing, Keith, but the only ones supporting the secondary market this week are non-bank. Penny Mac, Mr. Cooper, all the rest of them, Freedom, they're out there buying loans from independent mortgage banks. The commercial banks have disappeared. JP Morgan slammed the door last week, basically shut down their warehouse lending for non-bank mortgage companies. So, the private sector, the sector that's not supported directly by the government, which includes the banks, is going to suffer. And the banks are going to be protected, as they always are.
Well, it's an interesting debate too. I mean, we talk. Everyone wants to talk about Fed liquidity, and I want to talk to you about that too. But the difference between, at a very basic level, Chris, because you're a good teacher, what is the difference between liquidity and solvency that we should be concerned about here?
Well, liquidity is when short-term demand for an asset class changes very suddenly. So you saw high-yield debt run up in yield to 10 points over treasuries. It's come back. Yep. Special assets that don't particularly fit into the square hole. So, for example, floating rate mortgages. Those are not deliverable in the mainstream TBA market that we use to do securitizations. So there was no bid. Specified pools, which happen to be the mortgages of low-income borrowers. And again, very specialized market, stop. Non-QM loans, fix and flip mortgages, all of this stuff that was what we call the fringe market in non-bank consumer finance, it's all gone.
Yeah.
It's like California and Texas in the spring when you have the flowers growing, and then when the sun comes out later in the season, it's all gone. And that's essentially what we've seen here.
Well, so can you take me back to pre the season changing, using that metaphor, and pre-virus, and where we are post? I mean, How much has the world changed, and how much market risk is associated with a lot of these different, what I'd call super pro-cyclical late cycle investments that people made? What do you think the world really has now in a bag of risks on that front?
The risks are rather considerable, and they go on and on. They're difficult to really quantify. So first and foremost, new issuance in most of these sectors is pretty much dried up. So companies that needed to go back to the market and refinance their debt are not going to be able to do it on anything like the terms that they were anticipating. You think of people like WeWork. You think of all kinds of other leveraged enterprises that were using high yield debt to buy back stock, for example, or any other purpose. That's over.
Oh.
You saw that, by the way, at the end of last year. The new issue market in ABS and corporates was slowing considerably.
Yep.
And yet, we didn't notice. So going forward, I think you're going to have large sectors of the world of non-bank finance, asset-backed securities, collateralized loan obligations. No, they're not coming back anytime soon. I'm sorry. Even if the Fed is out there buying AAA tranches of existing deals, it's going to be very, very, very difficult to get investors to come back to the table. My favorite, by the way, you want a poster child for this downturn, Keith? The credit risk sharing securities issued by Fannie Mae and Freddie Mac. Okay? They traded down into the 70 because these securities are not eligible. They're not agency securities. They're just corporate debt. And there was nobody trading them. So I think any notion of taking Fannie Mae and Freddie Mac out of government control is pretty much dead now if you look at the way those securities behaved. I mean, imagine if they were already out of conservatorship and they were out there trading like, penny Mac. That would not have been good.
Yeah, let's just dig into that, to a couple of those points a little deeper. I mean, you mentioned CLOs. I think that might be a little out there for people, but not something like, and you've talked about this, BDCs, pick any levered long investment, REITs, and how they fund their business. REITs is a massive component of any quote-unquote diversified equity portfolio right now. Maybe use that one because that's the one that people probably would care the most about. But again, you could talk about whatever you want.
Yeah. Well, the REITs are interesting. They're very diverse. You have REITs that own buildings, the equity REITs, and then you have the agency REITs that typically own mortgage-backed securities. And then finally, you have hybrid. You have people like New Residential, the Fortress managed firm that owns everything. They own mortgage servicing, they own whole loans, they own consumer loans. And what's happened is the liquidity around a lot of those asset classes disappeared. And many of these REITs, not just NRZ, but a whole class of them that had provided a very important investor component to these markets and were encouraging the growth of the non-agency mortgage market, construction loans, all sorts of things, has basically just disappeared. So those REITs were forced to de-lever. They were forced to sell all of their non-agency holdings and go back to square one. And that's where they are now. A lot of people are looking at them as potential investments. They're looking at the yields. But I would just point out to you that leverage upon leverage upon leverage, all the way up the stack in these entities is dangerous. And remember, REITs don't have capital. They can't retain any capital buffer. They have to pay out all of their earnings pretty much every year to investors. So they're basically a pass-through. And that's why the Fed and the other regulatory agencies in Washington have always been very careful with REITs. They would never let a REIT own a bank or anything like that. And I think, unfortunately, these and the funds that were involved in real estate, Keith, are really the losers. The non-bank mortgage companies, they're going to have a lot of work to do over the next couple of years, but they're going to make a lot of money on distressed loans as they fix them. And they're going to have a huge crop of very, very valuable servicing assets.
Yeah, well, the distress.
These loans won't prepay for over a decade once they're refinanced.
Yeah, your eyes got really big when you started talking about the opportunity in distress. I mean, that's. But I talked to.
That's how we make money in mortgages.
Exactly, but it's been a long time coming. For people that don't know what a distress cycle looks like, I mean, it's been 129 months of U.S. economic expansion, so you haven't had one. I mean, I'm interested in your feedback on this. One of the biggest distressed investors that actually is still around, a client of ours, is having a call with them last week, and they were like, really? Like, Keith, like, are your guys and gals there on the equity side? And this was post, the Fed's whatever infinity move. They're like, really, do they think we're actually going to bid up here? What gives here? They're almost dumbfounded by where some of these marks have gone in public markets relative to where they'd be willing to where they'd be willing to buy them for real. Like, any thoughts on that?
Interesting how quickly we bounced. Yes, I mean Wall Street is showing a capacity to get comfortable after anything. The Antichrist could appear on Lower Manhattan, and I think it'd get comfortable with that.
Yeah, right. Yeah. But I mean, it's just, to me, we also have guys, throw up slide 74. Chris will have some thoughts on this. It's just endemic to something that was already cracking in the credit cycle for it to go full bore. What I'm showing here is total delinquencies, C&I loans and leases of U.S. commercial banks on a year-over-year basis. And if you go back to the prior two, just the two that I've had to risk manage through, which is the 2000 to 2002 period, and of course 08. Why wouldn't it be, with this kind of leverage in the system on the corporate side, just this protracted playing out on this chart? People can see this. I don't know if you can see it, but the red line, as opposed to this, it's one and done, the Fed's in, we're all good.
Well, the market risk component, the Fed has been very helpful. We're still going to have ugly marks. Look at the MSR mark that JP Morgan just reported. My God, they cut the value of their servicing by a third.
Yeah.
In one quarter. That's because of the market volatility. But I think in these other asset classes, C&I lending, which didn't do so bad in the 2008 crisis, really, had normal performance for a recession. That's going to be a very hot area. I think multifamily real estate, which had been on a tear, rental properties, all of these things where, investors were flowing. This time around in real estate, it's an institutional and a commercial story, although residential is also going to be ugly. So, there are cycles for these things.
Yeah.
And I think, my God, the cleanup in rental properties, for example, after months of moratoria, tenants just leaving, it's going to be quite interesting. Keith, think about how many young people who worked in the services sector in New York City have left in the past 60 days. And they're not going to come back unless they have jobs.
Well, I mean, for a whole generation, it's the first time they've lost their job. Let's just start with that. But so bridge the gap for me and just simplify this for people, all right? Because you said it takes time to work out. It takes time. It's the cycle, stupid, is what I try to boil it down to. But you have the Fed, you got epic liquidity, you got forbearance, all this stuff in the short term. Like you said, good job, you guys did what you're employed to do. But what happens next if time and space is just an economic depression and or resuscitation into some version of a recession? What happens next? What do they do next?
Well, next, I think, is you see the slow reopening of most of the economies. You get the people back to work that you can get back to work. But you find out that a lot of the investment structures that were created during the boom, the Fed-induced boom, and the asset appreciation phase are just not going to be viable, so they're going to be restructured. The good news is that commercial real estate, those sorts of investments are all professionals sitting at the table. They'll wipe out the equity, they'll recap the structure, they'll convince the original manager to stay in, they'll give them some equity, and off they go. They'll extend and pretend, right? In the resi side, you're dealing with consumers, you're going to end up with a lot of defaults. I think half the people that look for payment assistance on their mortgages are going to default, Keith, ultimately. And then with all the commercial loans, again, professional defaults, that sort of thing. But when you don't have a lot of demand in services and for service businesses, those little owner-occupied properties that were so popular in major urban areas are basically going to be completely orphaned. Nobody's going to want them. And the banks are going to end up, in many cases, just charging off those properties and getting rid of them. So it'll be a big opportunity for the vultures here. They're already gathering in large numbers. But it could be quite ugly for earnings for a while. And again, bondholders on the non-agency paper are going to pay the freight. That's what it comes down to.
How do you think the handoff looks from private equity, procyclical private equity, I'll call it, to the distress side? I mean, a lot of the older shops. I mean, if I go Apollo, for example. I mean, you go back to I think 1990. They're set up for this, but not all the procyclical newbie private equity shops are.
No, but they'll figure it out. You'll see the lawyers shift the restructuring and away from new issue business. There's going to be a whole redeployment in the professional sector to deal with this stuff. And you mentioned private equity, Keith. Think about oil. Back in 2015, when I was still working with my friends at Kroll Bond Ratings, we were waiting for the apocalypse in the oil sector. We had half a dozen fairly large community lenders that were focused on that business. Cadence, with Paul Murphy, a great banker, and yet it didn't happen because yet private equity came to the rescue. This time around, I think the degree of price drop in oil and other types of services around the sector is going to create a feast for the vultures. But I can't believe the private equity guys are just going to show up again and recap these companies to keep them in business at these price levels.
Well, I mean, it's an interesting setup. I mean, a lot of the new deal flow, obviously, if not all of it, is shut down, and now a lot of these private equity companies are dealing with, trying to deal with losses at the portfolio
That's
companies,
right.
which is I have some
But the funny part is going back to our metaphor about the highway, flora in California and Texas. If prices come back in shale, then the companies will come back. They'll just grow back.
Yeah.
This is what drives the Saudis and the Russians crazy, because they think they can kill this. But no, we'll just recapitalize them and bring them back.
Now, how about on, and again, if you guys have questions, please pop them in the queue. But for those of you that don't know, Chris is a historian on many levels. You wrote a book on the auto industry, the Fords in particular. What do you think happens to auto here?
It is going through something that looks an awful lot like the 30s, which were very tough for the industry. The only thing that saved them was the war, because the government paid them cost plus to build tanks and planes. I think this is going to force a lot of consolidation in the industry. My favorite, speculation has been that you'll see Volkswagen and Ford get together. Because VW, they're one of the survivors in the global auto race. There'd be one Japanese firm probably built around Toyota, and then, what do you do with the Germans? I mean, you put BMW together with Daimler. BMW is too small to survive on their own in a market where we're at half of the run rate we were at last summer, right? There's not enough sales for them all to stay alive, Keith. So we're going to have to figure this out. Mm-hmm. I guess they can build ventilators for a while, but that ain't going to fix the problem.
Mm-hmm. And another book you wrote, on fraud, confidence, stuff like that, financial stability.
Yeah.
What do you think? Where do you think I should say we're at in terms of the fraud cycle? We've actually seen some epic frauds on the Chinese equity side already. I haven't seen the big kahunas in the USA yet, but I have a sneaking suspicion they're there.
There's always a hot spot somewhere in finance. My sense is the bond market, especially some of these covenant light deals that were done, are really going to be problematic for investors as these companies are downgraded and end up getting restructured.
Right.
The key point about that book I wrote with Fred Feldkamp, was really that benevolence gets you more bang for the buck. So even though we probably overreacted somewhat to COVID-19 in terms of the medical response and the civil response, that's okay. But we have to be helpful to people, because if you preserve jobs, you see people like Amazon out hiring people, and they're just telling them, come on, we'll give you a job, come help us, and then you can go back to what you were doing. That's very important. Because to the extent we can keep things intact, we can keep lives and businesses intact, it's going to help down the road. And that's really my big concern. You have a lot of people in the industry, unfortunately, and in Washington, who don't take this view, and they don't understand that being miserable ends up getting you a lot of economic pain. Mm-hmm. Whereas, being a little bit generous and, for example, helping the loan servicers deal with this forbearance. Oh my God, we have millions of people who were told they don't have to pay their mortgage. Mm-hmm. What do we do with this?
No, I mean, people paying their mortgage, small businesses not being able to pay their rent. On that topic today, again, a couple 8Ks filed. JP Morgan lent through the SBA loan program 10, 20 million bucks to, I forget which one to which, but Ruth's Chris and Potbelly Corp. Great name for a little pork there. But I mean, how do you think that plays out in America? That's a bit of a bigger question. But again, picking winners and losers. I mean, there's a lot of mom and pop restaurants that aren't getting jack shit in terms of that SBA loan program, at least not yet.
That's right. That's right. And I'll give you a great example, a chain that a lot of business people use, the Palm. Palm filed bankruptcy immediately.
Yep.
And laid their people off. And a lot of my friends were upset. I thought, no. This is what's called the beginning. This is a negotiated tactic. Because the obligor for all those leases around the U.S. is now going to turn to the landlords and say, do you want us to stay in the building? And the landlord, who's faced with having a vacancy, is going to have to think long and hard about maybe coming up with a solution. And I think you're going to see that play out all over the place, because a lot of chain restaurants, for example, they're owned by REITs. The last thing the REIT want is for that chain to close up. Mm-hmm. They're going to do everything they can to help their tenants. And if you talk to anybody in the multifamily or the commercial world, their chief concern, Keith, is the well-being of their tenant.
Yeah.
And that's how it's going to play out, because there are commonality of interest here.
Yeah.
You don't want them to close. I live in a building on Central Park South. We have 2 restaurants downstairs. I can guarantee you that the landlord, who's a dear friend of mine, Dale Hemmerdinger, one of the great men of New York real estate, he's going to be making sure that those tenants are okay.
Yeah, I mean, that's on our call today. Howard Penny, I think you've known Howard for a while. He's like, I said, well, how did that happen? How did the pork belly and the Ruth's Chris get to the front of the line? And he's like, because they're clients of J.P. Morgan. Of course. I mean, that's the answer. It's the simplest answer. They're taking care of their clients. So that's an interesting one. There's also a bit of and we'll get to your questions here coming up. So please ask, fire away. There's a bit of a social media flare-up not that I'd ever have one of those, but that I think I actually was part of it this weekend, where Scott Wapner had this moment with another Canadian guy about why companies shouldn't be able to fail. I don't know if you saw that or not, or if you had opinions on that particular, not in particular that moment in terms of the dialogue back and forth, but why is it important to have companies fail?
Well, there's this socialist notion that is basically taken over the economics profession, that we have to protect our economies and our financial institutions from deflation. And so the way you do that is you don't let people default on their debt. But that doesn't work. The central banks, Keith, have been trying for 10 years to prevent debt deflation. And along comes this external event, and boom, we have this mass evacuation. So I think that, the lesson is let the markets operate. You could give this message to the Fed. You could give this message to many other policymakers, because they think they can do it better by coming in and intervening in the marketplace, but they can't. The market for resolution in the United States, or bankruptcy courts, are very important, because it's by having a prompt and a timely resolution of insolvency that we get the economy moving again. Yeah. You go to Europe and you could have an insolvency that goes on for decades, mm-hmm. and it kills the economy. So it's good. Look, a timely resolution, finality in terms of default, is very important. And that's why the framers of the Constitution, one of the few things they told Congress to do was to create federal bankruptcy court.
Yeah, of course.
And
I mean,
it's very important.
It's one of the great parts of the American capitalist story, free market capitalism at its core.
It's essential.
Yeah,
it's essential.
We and because it puts the fresh new capital in the hands of new owners, where it can take a different look at the business, put some energy into the business, and more capital. Right. And more capital has to do with more energy. We bought not that anybody cares about this, but we bought the Phoenix Coyotes, which are now the Arizona Coyotes, at a bankruptcy group that I was part of. And that was phenomenal. I mean, you had a dysfunctional situation that all of a sudden had liquidity. And bang, now all of a sudden, we brought it back to life. And I'm no longer part of that. But I mean, just going through that experience, because again, there was a lot of debt involved in that situation. I'd hate to see in America. I came to the U.S. in the mid '90s, wanting to. I'm a Canadian who just wanted to be like an American, red, white, and blue free market capitalist, and I just, that was the calling card. And that to me, I wonder if people think that is in jeopardy.
Well, I think there's a lot of muddled thinking on the part of Americans. We're very spoiled. We've had our way. The dollar is the global currency, so we can behave like drunken Argentines and not suffer any immediate consequences. But I think down the road, we have to realize that the toughness of mind and the discipline that built this country and built all the capital that we benefit from today came about because we were willing to let people fail. It's extremely important. Look at the airline. The airlines are all fighting not to go bankrupt, but it's kind of pointless. Creditors own those planes. Those planes are beyond reach. So all that's left is the gates and a few brands and some intangible assets, right? The industry is imploding. We're running at 60-70% of capacity in the U.S. right now. So those routes don't have any value at the moment, Keith. Think about what's inside of an airline if you take the planes and the gates away. There's not much, so you might as well restructure.
Right. Yeah. That industry gets people, that topic in particular gets people going. All right, I'm going to get into, if you don't mind, Chris, I'm going to get into some of these questions here.
Sure.
And the first, actually, the highest rated question has to do with, I don't know if you have thoughts on this or not, but it has to do with supply chains away from China. So will companies in the future, will this perpetuate a move away from supply chains in China and result compress corporate profits or raise consumer prices?
I think the answer is yes. Both the national security concerns and other concerns have been pushing companies to look for alternatives to China for a long time. China had become quite expensive in many respects for global producers. But I think the Chinese had the capacity to meet the demand. Right. And as Vietnam and other countries increase their ability to take that business away, I think they're going to get it. Mm-hmm. I'm a student of China. I follow the country very closely, and I'm convinced that we're nearing a point where the end of Chinese communist rule is in sight. I know people think this will never happen, but I beg to differ. I think the people of China want to be free just like everyone else.
Well, I think that's a big thing that people missed. A lot of these apologists, I'll just call them for now, that says, hey, nobody could have seen any of this
coming. That's what they are.
Nobody could see this coming. It was just the virus. That's bullshit. I mean, China started slowing at the end of 2017 within a secular story that is quite damning on the industrial and manufacturing front. So again, they've tried to stave off recessions, or at least stating them as much as technical recessions for quite some time here. So you have a lot of big issues that were boiling in the background that I think that it's so lazy, and in fact it's reckless to make the statement that nobody could have seen that coming.
If you look at some of the reporting, the Journal had a great story. My friend Lee Miller at China Beige Book, all of them are focused on the fact that demand had already started to taper off a while ago. Yeah. In terms of Chinese exports. And then you throw this into the mix, and you're going to have the U.S. and Europeans basically telling major sectors of their economies to start sourcing internally. Even Mexico, even Latin America writ large would be considered a better alternative, or Canada, for the United States to source new products. And I think that's what they're going to do. Yeah.
That's interesting. Well, part and parcel with what happened, in China into the peak, don't forget. Many may or not have remembered the capacity build out into the peak in the commodity price that was a bit of an echo to that 2007 Chinese.
Oh, yeah. That was driven by the Chinese. I mean, they did that.
Yeah, epic.
They're manic. The state and the Communist Party will do whatever they have to do to keep things stable. Grotesque amounts of debt. They have more debt than we do, Keith.
Yeah, they got more debt than anybody. I mean,
so at a certain point, the whole thing is going to implode on itself. We just have to be prepared for that eventuality.
Yeah, well, what I was going to try to get, I agree with that. I mean, what you get out of that is these boom-bust cycles. The Chinese perpetuated. Bernanke devalues the dollar to a 40-year low in 2011. Commodities at all-time highs. Gold, its prior all-time highs. That was that created an imbalance of supplies. So now you got the washout in the energy space, and this is actually one of the second highest voted question. It actually surprises me. Maybe it shouldn't, because you're going to have an opinion on this. But looking at the fallout, for example, like midstream energy. So the question is implying that is actually finally undervalued, or maybe a place to go from a long-term infrastructure asset investment perspective. Do you agree with that or no?
I think you would have to be very, very careful. That's it's funny. Exploration tends to be funded with equity. As you go up the production chain towards distribution, you can get more debt and leverage involved, and typically bank loans. To come in there and buy this, though, you're going to have a really strong constitution, I think, because I can't tell you what's going to happen with demand in the near term. I like transportation. I own Williams, but I guess I would say to you this: between conservation and between what I think is going to be an L-shaped recovery in terms of GDP and overall demand, I don't know if we're going to fix oil demand anytime soon. There's just so many people out there that are dependent upon oil to fund their countries and their governmental structures, like the Saudis and the Russians. They can't back off. Where are they going to go?
Right.
They're a one-trick pony in Russia. They're basically a big commodity producer with nuclear weapons. Okay, but they have an economy that's smaller than New York State. So, I don't worry about the Russians. I think that we have to worry about the fact that, we have in the U.S. pretty much taken care of our energy needs. I think at some point we are going to fulfill the vision of Marconi and electrify the whole country when we figure out how to do it without lithium batteries. And that's I think the U.S. is going to lead the world in that sense. But, the rest of the world, the third world, is commodity dependent. I don't know what happens with that, Keith. I really don't.
No, and in dollars, that's an important part of the answer too.
That's the thing. It's funded in dollars. The whole world is short dollars.
Yeah. Well, so if you go back, and a lot of people still don't quite know the difference between now and 08. I'm like, it's absolutely not like 08. At this time in 08, when the Fed was panicking and the government was panicking across the board, oil went to $150. I mean, it's like these aren't even remotely close. And I wonder. I mean, it's kind of interesting too. I mean, it's one of the few things the Fed, other than just stocks, hasn't started to buy. So it, of course, is allowed to crash properly.
The Fed doesn't need to buy stocks. People have to stop with this Japanese metaphor. The U.S. has a private bond market. That's the thing that differentiates us from the rest of the world. So I'm not worried about equities. Equities come back all on their own. I can guarantee you the one thing Jay Powell doesn't worry about when he goes to bed at night is equity, because that is the most liquid hedge for inflation that investors have.
Yep.
Real estate is also a good one, but when too many people chase it and it becomes grotesquely overvalued, as it has been, that causes problems. But to me, as long as the bond market comes back, as long as we get credit spreads and particularly high yield spreads back down, you want to see high yield below 500 basis points over the curve, then we can get the party started again.
Yeah. People don't quite know what the pre-party looks like on pre-packing bankruptcies, though. Because
we're not going to be doing CLOs this year, I can tell you that, Keith.
Yeah, how do you have a party if you don't have a pre-party? I mean, I'm Canadian. I know exactly what the answer to that is. So you can't.
Yeah, but there was some ugly leverage. You saw some banks puking collateral over the past couple of weeks, and the reason for that was all these swaps that were put on between non-risk collateral on the one side and basically crap on the other. We've seen this movie before. And so it was all inside the banks. You couldn't see it because these were the swaps. But they were out of the money, the margin calls were made and not met, and so they had to shut it down.
Yeah. Now, a couple questions have moved up in the queue here in terms of their rank, and I think it's because of what you said, obviously. But if that is your view on China, and we have a different or a new normal developing in America from an internal capacity perspective, do you see inflation coming for real?
Not in the near term. I think deflation is still the problem.
Yeah, there are a lot of different views on that. I guess people are so wed to the lessons of history. They just want to like tape this period in time to that period in
Yes,
time. And
but remember the key flaw in the Piketty analysis in Capital was that he didn't realize that data series change over time, and the big factor that has changed is demographics. The population is not behaving the way it used to. When I was young and my parents were making babies and buying houses in Washington, you had consumer demand type inflation, and you had labor inflation too. But today, no, we have a surfeit of labor.
right. I mean, well, the demand shock is what it is. But this question too really gets to the other side of that question, which is why not deflation? Christian is asking: is the world going to emulate Japan, experiencing the slow asset price declines as a result of corporates deleveraging, decline credit availability, no global engines of growth, et cetera?
No, that's a bit too dystopian for me. I think what you're going to see is a reset in asset prices. The righteous who have cash are going to come in and buy these assets.
Yep.
and prosper as a result. And, we're just going to have to work our way back to something a little bit more national and regional and much less globalized. I think globalization is done. You're going to have commerce between nations and travel, but I think the nature of that is going to be very different than you saw previously, and the cost of travel is going to be much higher. So, to me, I think that it's always good to let people benefit. It's always good to let savers come in and buy assets cheap. And the central bankers have refused to do this. Why? Because all of the public issuers, all the countries, are over indebted. And so they're afraid that the whole structure falls apart. In the post-war world, we put government at the top of the pyramid, which is a mistake, but that's the way it is.
Yeah.
And the whole dollar system is based on the Treasury and the government-insured mortgage market as the foundation. So, that's all we're going to have left for the time being. You're going to have high-grade corporates. You're going to have government-insured mortgage paper, a couple other things here and there, but there's not going to be a lot of liquidity for assets. But that's an opportunity for like I say, the righteous. The meek shall inherit the earth, right? And especially if they've got some cash.
Yeah. Well, I mean, particularly given your points too on the banking system's liquidity reserves, stuff like that. I mean, is there an actual? And this is one question. I don't know if you made a star of yourself on this, but I think it was due to some Real Vision interview that you had. I love Real Vision. If you said, Chris, I loved your interviews on Real Vision. If you had to go all in one banking stock going forward, what would the bet be? I didn't know that you were going all in banking stocks.
Well, I don't make buy-sell recommendations because I'm an investment banker, but I can tell you what I own. I own U.S. Bank Common and Preferreds.
Okay.
I own Citi Trups, which I love, the 9 3/4 of 40. I own Bank America Preferreds and boring stuff like that. I have tended, and I own NVIDIA. And when it sold off, I went and bought a boatload. So, my portfolio is not down very much because it's very boring. Yeah. I gave the rest of my money to my wife, who's a private banker. And they've been getting slaughtered because they had a lot of equity exposure. But I pointed at her mine. I said, look, boring is good. But I think my stars I got out of the REITs in 2018. And what I would tell you is go shopping, look for value. You want to buy strength right now. You don't want to go reaching for the outliers because, let's face it, Capital One, Citi, Goldman Sachs, they're cheap for a reason.
Yep.
In the case of the first two, it's credit risk. In the case of Goldman, it's really operational risk and this huge question mark that we can never resolve, right? You don't know what's going on there, and they are not very good at articulating what the plan is going forward. Citi has the same problem. Mm-hmm. So, I love U.S. Bank because they're the best performer in the top 5. They have a great funding base, and they're going to do fine. They make enough money that they don't even think about touching their dividend. They don't have to.
Yeah.
JP Morgan, Wells, they don't have to think about this. Bank America, mediocre performer in terms of asset returns, but my God, Brian has de-risked the bank so much that they're not really that exposed. They're going to take, consumer defaults, but they don't have a huge capital markets focus, even with Merrill Lynch.
Well, you just ring-fenced a bunch of the final questions there. We're we're at the 45-minute market here, Chris. So thank you so much for your time. I mean, we can go anywhere with you, and that's why we
you
love,
always have
love
to
having
wait
you
for
here.
the end, the best part.
Well, I appreciate it. Thank you. You can find Chris Whalen on Twitter. He's quite active, obviously quite knowledgeable as well. Up next, we have one of my favorites. I don't think you know this guy yet, but his name's Mike Taylor. Mike T. Looking forward to that discussion in about 15 minutes.